Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories now we're following in the BNN Bloomberg newsroom. U.S. President Donald Trump is in China at the start of a multi-day trip. It will include a meeting with Chinese President Xi Jinping. This marks the first visit to the country by a U.S. president in nearly a decade. Trump says his priority is trade, not the war in Iran. He was joined at the last minute by NVIDIA CEO Jensen Huang, who is accompanying other executives, including Elon Musk and Tim Cook. We are watching shares of Equinox Gold and Orla Mining right now. Equinox up 2.2, or down 2.2, and Orla's up 0.35%. This after it was revealed Equinox is buying Orla in a stock-based deal that values the miner at $5.1 billion US. The deal will give Equinox access to Orla's assets across the Americas, including its flagship mine in Mexico. Equinox shareholders will own 67% of the new firm, and Orla's shareholders the remaining 33%. Orla's CEO Jason Simpson says they're hopeful stakeholders will see the value in the created combination.
We know that we've got the support of our major shareholders in this transaction, and we are hopeful that the remaining shareholders will also see the value in what we've created as a combination. They saw the value in what Orla had in our growth platform, but had to be patient with its delivery over the next 5 to 6 years. In this situation, they will not only get the assets they're familiar with at Orla, but get access to the great assets that Equinox has.
Shares of Boyd Group are taking a hit. The operator of collision repair centers reported adjusted profit in its most recent quarter that fell short of expectations, while same-store sales missed estimates. Boyd saw a net loss of nearly $8 million US, which it says was caused by acquisition and transformational expenses related to its Joe Hudson acquisition and Project 360. Boyd says the costs are expected to decline as integration finalizes. And taking a quick look at the markets, looks like an off day for the TSX. Pretty much every indice is in the red, save for materials and healthcare. It's off right now, 0.68% for the day. South of the border, bit of a mix. You can see the S&P 500, though, looking solid as it pushes towards 7,500. It's up 0.6%. And the NASDAQ, well above 26,000. It is up by 1.25%. All right, markets are mixed as the investors weigh the latest U.S. inflation data, but our next guest is watching a resurgence in tech and AI. Let's get more on the broader markets from Chris Vermeulen, founder and chief investment officer of the Technical Traders. Chris, thanks very much for joining us today.
Yeah, thanks for having me. Pleasure.
After a brief off day, looks like everything's, I want to say back to normal, but that almost feels like what it's saying right now. The tech taking off again.
Yeah, I mean, we had a little bout of selling. That was about it. It seemed like a little wave of profit taking. Instantly, the dip got bought back up. Stocks rallied. And that's kind of what we're seeing in the market. We're in buy the dip mentality, high momentum move. The stock indices, the S&P 500 and the NASDAQ have been running up the 5-day moving average. Anytime the 5-day catches up to it, we see the market pop. And really, everybody just wants to be risk on, right? We're seeing small caps and micro caps do well over the past several months. We've seen technology lead the way, and AI's just got everybody going. Semiconductors surging, and everything in part of that AI space on the technical side or the hardware side is doing very well.
And is it realistic, or is this getting into overblown territory?
You know, it's really tough. It does feel like it's getting a little frothy. Like we're seeing money just pile in, like semiconductors up over like 56% in the past month and a half. There's a new ETF that came out, DRAM, which is a memory ETF, memory stock ETF. It's up over 100% in the last month and a half with massive volume, huge volume, like 40, 50 million shares traded on a new ETF. So I feel like we're a little bit in the feeding frenzy mode where everybody just, it's easy money, just get into the tech space and just ride it up. That is usually a warning sign that we might see a little bit of a pause that could last a couple weeks or potentially a couple months and put investors through a little bit of a roller coaster ride. But I mean, the AI space is still like just the tip of the iceberg, right? How big can it be? how big will it be? And these are the biggest tech companies dragging the markets higher. So, if you look at the S&P 500 equal weighted or the TSX, they're not really hitting new all-time highs. The overall general stocks aren't dramatically higher. It's the S&P 500 and the NASDAQ because of the technology. So the question is, how big is this AI? I say bubble, but I believe it is the real deal. There's lots of upside, I still think. But it's definitely a little nerve-wracking because it is one sector doing pretty much all the heavy lifting for the market.
Well, it does start to feel a little bit like too much of a good thing, doesn't it?
It does, yeah. It has a lot. The feeling we're starting to get right now is actually similar to the precious metal space earlier this year in silver, where silver was up like 5-7% every day, day after day after day. And it just got, very crowded and became a strong emotional FOMO move. And so, now we're starting to see silver come back to life, which is silver is a speculative play. It's been moving with equities quite a bit. And people are piling into it because they want to make money. It is risk on mode right now. People want to move into the fastest moving things. They're not interested in utilities. They're not interested in consumer staples or dividend stocks. They want tech. They're starting to move into precious metals. They want what moves fast. And that's great. I mean, you do have to be long equities. We're long equities with the S&P 500, the NASDAQ, and really we just have to ride this trend higher. But just know that the easy, quick, big move has been made. Now the question is, can we preserve the capital and what happens from here?
And with the metals, gold as well, but silver really has jumped. Gold's been steady again, but silver's jumping in the last couple of weeks. Do you see that trend continuing?
Yeah, so there's a little bit of a mixed signal in the precious metal space. So silver's jumped. It's created a lot of anxiety. People who aren't in metals are thinking they need to get in. It's going to run without them. But silver naturally will spark that because it is starting a short-term uptrend over the past about week or so. The problem here is gold hasn't broken into an uptrend yet, and gold and silver miners also have not started an uptrend. So silver is the only one in that pocket. And for me to be confirmed that I like the new precious metals trend potentially going up, I really do want to see gold moving up. I want to see miners. I want to see the whole kind of space, the whole complex, not just silver popping, because silver is very, very small market. When everybody piles in at the same time, it creates these big pops and it can create a fake out, meaning it'll pop up and it sucks a lot of people in, gets them excited, but then it reverses back down. So the precious metal space I'm keeping my eyes on. If silver and gold and miners do all start an uptrend, silver's got a lot of potential. I mean, the chart is pointing to about $175 per ounce for silver for the next major run up. So there is potential. It is pretty exciting, but I want to see the whole space confirming that there's an uptrend in precious metals across the board.
All right, and of course, the other wild card right now, oil and the impact, energy in general. What do you see there?
Yeah, I think the whole Strait of Hormuz that's going to drag out, I think, a lot longer than we anticipated. For a little while there, I think everybody was thinking, oh, this might get sorted out, but I think it's here to stay for a while. And so that's priced into oil. We're seeing that priced in. But now I think the problem is the longer it stays closed, the more we drift into this supply and demand issue. We're starting to see the U.S., I think, tap into their reserves. And that means there's going to be real supply and demand pricing coming into effect. As supply goes down and demand remains the same or actually increases because people are falling short and need more, it's going to, I think, keep oil high and potentially push it even higher, which sparks the problem of inflation, which we're already seeing with CPI. And of course, that means higher interest rates potentially and lower bond pricing. So there's definitely a lot going on. The energy space is, I think, a good driver of what's going on with interest rates and bonds. But the equities market isn't putting up with it. It's just going higher. It doesn't matter how high oil goes. Technology is just dragging everything up with it.
All right, we'll leave it on that note there. Chris, thanks very much for joining us.
Thanks.
Chris Vermeulen is founder and chief investment officer of the Technical Traders. Up next, a mining merger worth $18.5 billion US. We'll discuss more about the deal between two Canadian companies and what it means for gold production. Vancouver-based Equinox Gold is buying Orla Mining to create a gold producer with a market value of $18.5 billion. Let's bring in John Ing, President and CEO of Maison Placement Canada, to discuss more on this. And John, thanks very much for joining us today. This deal, do both sides win? Is there one clear winner, or is everybody happy?
Well, this is sort of like Bay Street's game of musical chairs. We have two mid-sized companies getting together, one on a growth curve. Equinox has been on a growth curve. And the acquisition of Ola brings yet another group of mines. And so we have a combination of 6 mines. All of them, I might add, or the majority of them, are in transition to that growth curve. And importantly, 62% of this bundle is in Canada. So from a geographic point of view, it's a major plus. From Bay Street's point of view, it's a combination of Bay Streeter, Ross Beatty, you have Pierre Lassonde here, you have Tony McCooch in the mix, you have the Fairfax group, and Eric Sprott. So putting their interest together in this combination makes a senior producer of 1.1 million ounces, potentially growing to 1.9. But as I said, the key is that the mines are in transition.
And in transition, how do we take that? Is it a good transition, and is it on time, or is it something that may be a problem?
Well, 3 of the mines, for example, you take Ola's Musselwhite, recently acquired from Newmont, and that was a mature mine. And Tony McCooch came in, and he knows that area, but will they be able to shine this up? Will they be able to make it grow? Remains to be seen. Equinox, Valentine in Ontario, it's really started only in the last couple of years. And then we have Valentine in Newfoundland. And that's also a recent start. So the best, we are told, lies ahead in these mines, thus the expectation of growth. But as we find in mining, there are sometimes the occasional execution problem, the occasional something that we did not expect. And so when you look at the combination, the Equinox is paying something like $220 for the reserves, the P&P in the ground. Mm-hmm. And that's a good price. But as far as will it be a great price, the future remains to be seen. The next couple of years as to whether they can get the execution, and the future we'll see.
And they've talked about 1.9 million ounces. Is that achievable?
It's achievable, but again, you take Camino Roja, which is an open pit. They did have problems in the past. They had a pit wall problem. The future remains getting the sulfides out. You have Mesquite, again, that's in the United States. There's a lot of potential. So the potential's there. There's no question about it. Management, the operations, of which you have Darren Hall. He's a good manager. He came from the as well as Chuck from the Gold Court days. Management of these mines will be very important in squeezing the potential out.
And gold, the price of gold, was that a factor at all in this, or is gold just where gold's doing what gold is going to do?
Well, in this climate, what gold miners' big problem have been reserves. They are flat to going down, and growth has been a problem. So this is the raison d'etre, so to speak, behind this this acquisition. The combination gives growth potential. The problem with the gold mining industry, there's more demand than there is supply. Gold miners aren't bringing on mines as quickly or as needed. And you have sovereign governments wanting more gold. You have the retail sector. Then you have the crypto people wanting more gold. And then, of course, the reason why is the geopolitical climate is suits gold, and gold is the best hedge against not only Mr. Trump, but all the uncertainties in the world.
And do you see more mergers coming up or acquisitions, depending on how you want to look at this one? I mean, we had Coeur Mining with New Gold. Do you see more in the future, in the next little while?
That's a great question. I think all the miners, you can pretty well fit all the big miners in one room nowadays. Everything, we did have a consolidation period, but now all the miners have abundant free cash flow. I mean, even this combination, they'll throw off about 1.4 billion in free cash flow. So that gives the miners a lot of currency in addition to their currency of their shares. They are on a growth curve. The problem for the mining industry is development. There's not that many great development projects that can come on stream in the next couple of years. And why I say that is because if you found gold today, it might take 10 years to bring that gold into production. By then, you would have missed the gold cycle. And that's a concern for the mining industry is that they don't know. I mean, we've had a great run so far. We don't know when this ends. So it's important to bring not only near-term ounces, but also mid-term ounces out of the ground. And that's not so easy, as miners have found out in the depths of when gold was only $500 an ounce.
All right, we'll have to wrap it up there. John, but thanks as always for joining us.
Good to be here.
John Eng, President and CEO of Maison Placement Canada. Canada's push to break its reliance on the U.S. is showing gains on paper, but a closer look reveals a much narrower story. We'll have more on that after the break. The federal government says trade diversification is bearing fruit, with non-U.S. exports up sharply since 2024. But much of that growth is being driven by volatile shipments of gold and oil, masking little real progress in expanding Canadian businesses into new global markets. For more on this, let's bring in Nojoud Elmalis, Canada's economy reporter at Bloomberg News. Nojoud, thanks very much for joining us.
Thanks for having me.
All right, let's talk about some of the numbers. We've seen an increase. How much of an increase, and how much of that increase is gold and oil?
Yeah, so as you just explained, the government has begun celebrating some wins on the trade diversification front, citing the fact that exports that are not going to the U.S. Have increased. But if you take a closer look, there's some specific reasons that's happening. And notably, gold shipments have really increased as prices have skyrocketed over the last year or so. And so if you actually strip out precious metals, which is mostly made up of gold, you see that non-U.S. exports are quite flat if you compare, December 2024, right before the trade war with the U.S., to March of this year. And so that's been a really big part of the story. The other piece is oil, obviously. There have been some wins on that front with the Asian market, but the other piece is, in March, when the Iran war was raging, you did see, obviously, Canada benefit from a windfall from that, and obviously those exports in value increased a lot as well.
And with the gold exports, I mean, have we seen an increase in the amount of gold actually being exported, or is it just because it's gone up so much?
I mean, it's twofold, right? So obviously the value is a big part of the story, and you've seen the value of shipments increase, I believe. Or you've seen these exports increase by 70%, again, comparing December 2024 until March. But depending on how you calculate it, you can see that not all of the gold is actually leaving Canada. And some of that gold is just exchanging hands on paper without physically leaving the country. And you can see that by comparing the balance of payments trade data to the customs trade data. Obviously, customs reflecting what actually comes into the country or leaves. And so it's a complicated picture on that front.
And from the other side, are we actually seeing any new business developing? I know it takes a while. You have to build relationships and build contacts. Are we seeing any fruits of the labor from that outside of the oil and gold?
I mean, so last year there were 300 more exporters who were exporting products to countries other than the U.S. The number of exporters exporting to the U.S. Declined, and so that led to an overall decline last year in the number of Canadian businesses that are selling their products abroad, and that reflects obviously the trade war. But there are some things like that, like the increase in the number of businesses sending products to countries other than the U.S. increasing is a good sign. Obviously, even on the energy front, that's a big part of the country's strategy moving forward for trying to diversify its trade, sending more shipments to Asia. That's a good sign. But I mean, it is early, as you said, right? The idea of trade diversification, that's something that happens over years. It relies on there being reliable infrastructure to make that happen. It doesn't happen overnight. And so while the government obviously is eager to declare some wins on that front, I think nobody's expecting that by now that this would happen, and it will take years for us to really see whether the government's successful in diversifying trade beyond the U.S.
All right, Noji, we have to wrap it up there, but thank you very much for joining us. Nojoud Al-Maliz is Canada's economy reporter at Bloomberg News. Up next, Denison Mines is out with first quarter results, sharing more details on its uranium project. We discuss more on that right after the break. Shares of Finning International are getting a boost today. That after the equipment dealer posted profit in its latest quarter that beat estimates, and also saw a surge in equipment rental revenue. Finning says the results were driven by higher construction activity and product demand in Canada. New equipment sales in Canada were also up 23% compared to the year before. We are tracking shares of Algoma Steel, up 0.73% right now, after it posted a first quarter loss of close to $160 million, along with a drop in revenue compared to the year before. The Ontario-based steelmaker says it incurred more than $27 million in direct tariff costs during the quarter. Algoma attributes these changes to its transition away from blast furnace operations to its new electric arc furnace, and that platform is now installed. Go Easy shares, more pressure for it, down again. Off by 5.6, roughly 80% for the last year. Company reporting a bigger loss than expected, adopting a shareholder rights plan as well to prevent any hostile takeover bids. The subprime lender has been grappling with losing money in its auto lending unit and writing down hundreds of millions of dollars worth of debt. The company says charge-offs will remain elevated, up around 17.5% next quarter, and will remain in the mid-teens for the full year. Go Easy says it remains confident it can return to strong credit performance eventually. Denison Mines saw a loss in revenue drop in the first quarter, but both measures were narrower than the same time last year. For more, we were joined by David Cates, President and CEO of Denison.
We've just started site preparation and early works for construction of our flagship Phoenix in situ recovery uranium mine in northern Saskatchewan, and that's our ticket to generating positive returns and meaningful cash flow for our shareholders. So right now our focus is on investing, and you'll see that, of course, in our financial results as we are investing in the construction of this new mine, and it marks the first new uranium mine that's been approved for construction and has started construction of a large scale in Canada in over 20 years.
And is everything on schedule still with it for mid-2028?
Well, with our permits being received in February of this year, the final permits necessary to start construction, and our quick decision to make the final investment decision, and then our ability to mobilize to site our integrated project team and start with that early works and site preparation program, we are still targeting to be in first production by the middle of 2028. And that's pretty unique owing to the mining method that we're working with, that we can have such a short construction period.
And what's different about that, the mining method?
Well, we're using in situ recovery. And so this doesn't require us to access the ore body via a shaft or a pit. and it doesn't require us to build a big mill. We're using a series of borehole wells that will be drilled from surface, and then we'll be injecting and flowing through the ore body a mining solution that'll dissolve the uranium in its position and then recovered back to surface through that same well network. And so owing to that, many of the time-consuming and costly aspects of building a conventional mine are bypassed. For example, we won't even have a conventional tailings facility that we need to build, and our process plant on surface won't be milling or crushing or grinding any rock. It'll just be precipitating the uranium out of the recovered solution. And so all of that makes the construction of our project much more simple, lower cost, and we can have a shorter timeline.
And this has been used elsewhere. What kind of success have they had with it?
Well, in situ recovery is the number one mining method for uranium recovery globally. It's being used in the United States, in Australia, and Kazakhstan, and other countries. But this will be the first deployment of the mining method in Canada for uranium mining.
All right, let's talk a little bit about McLean Lake and the joint venture operations there. How are things moving with the Sabre mining method ramp up?
Right. So at McLean Lake, we're a joint venture partner with one of the global leaders in our sector, Orano. This is a company that's vertically integrated in the fuel cycle, a nuclear fuel cycle, and they're an excellent operator, very safe and very credible. Happy to be their partners at McLean Lake. We've developed together with Orano over the last 20 years a patented mining method. It's called Sabre, stands for Surface Access Borehole Resource Extraction. And what it allows us to do is excavate the rock, so actually pull out the rock from a subsurface cavity, but do that from surface without having, again, to build a shaft or open a pit. And the mining method was commissioned, or the mine itself was commissioned last year. We achieved commercial production in the second half of last year. And we will be resuming production at that mine later this year. It's a bit of a campaign mining program at this stage. And so work early this year has been focused on resource confirmation drilling. And then later in the year, we will be transitioning into, again, excavating mine cavities and processing the ore. And the hope is that we'll be able to transition into a continuous mining operation over the next several years.
All right. And I believe you're sitting on about, is it 2.2 million pounds of U3O8? Is that right?
Well, the company had around 1.85 million pounds in uranium inventories and holdings at the end of the first quarter. And that's an important part of our balance sheet, gives us great strength as we move through financing our Phoenix project.
Are you going to be, I was going to ask, do you see a sell-off in the future of some of that then?
Yes, we acquired most of our uranium in 2021. We paid just under $30 US per pound. It was a long-term strategy to support the Phoenix project construction financing. And so now that we're into construction, that phase with Phoenix, we are drawing down and placing our uranium into the market. We've reported some of our recent sales, and I think the investors and the uranium market can see that we're being very responsible with our sales. We sold around 500,000 pounds, I think it was 550,000 pounds in the first quarter for deliveries over the next, call it 12 months, at a price just under $100, realizing around $99 US per pound. Right now, the spot price is in the mid-80s, so you can see that we're being quite savvy in the way that we're monetizing that physical uranium.
All right. And how are things going with that, the deal with Kosa Resources, that 70% interest in the 3 properties there? How is that working out?
Well, Kosa is one of our Team Denison investment companies. They're doing an excellent job working a portfolio of projects that we've invested in their company, including the Murphy North property in Darby. Denison owns a large shareholding in Kosa, just under 20%, and we're the direct partner on those properties. Kosa has an excellent technical team, and they've had some great initial results at Murphy North, as well as some encouraging results at Darby. And, you know, our strategy for growth at Denison is to work our own exploration portfolio, but it's also to amplify our exposure to discovery by investing in companies like Kosa. We're also invested in a company called Sky Harbor Resources, which has a project portfolio package that is adjacent to our Wheeler River property, and a company called Foremost Clean Energy, which has an option on 10 of our properties in the eastern part of the Athabasca Basin. All
right, just one last. You have 3 new board members. How are they fitting in? Where do you see their strengths being used?
Yes, so we also had our annual general meeting yesterday, and our board members were all reelected. Excellent rates of support. We have a board that has been recomposed over the last several years, and maybe I would just call out the caliber of some of these directors that we've been able to attract as part of a board rejuvenation program. Last year, we added Wes Carson, who is senior executive at Wheaton Precious Metals. We also added Ken Hartwick, who's recently retired from being CEO at Ontario Power Generation. And we also have a board member that's sponsored or appointed by KHNP, Korea Hydro-Nuclear Power, which is one of the company's largest shareholders, and they operate all the nuclear power plants in South Korea. So quite a high caliber additions to our board, building on top of an excellent board that we've had in place for several years now.
And that was David Cades, President and CEO of Denison Mines. Coming up, we'll tell you why some stocks in the U.S. energy sector are under pressure today. Stay with us. AI infrastructure spending has been lifting power stocks, but today shares of Talon Energy are selling off along with other U.S. power producers that sell electricity to data centers. Let's find out why. Joining me now is James West, Managing Director and Head of Energy and Power Research at Melius Research. And James, thanks very much for joining us.
Thanks for having me, Roger.
What's driving that today?
Yeah, I think it's a little bit of the PPI number, yields inflecting, and then also you had a county in Texas, Hill County, which instituted a one-year moratorium on AI data center building. So all that kind of piling on to the IPPs or the independent power producers today.
And is this a momentary blip, do you think, or is this something that's building?
No, I think it's a momentary blip. I think, look, the race for power and the data center story and the AI story is the most powerful story in the market today. And so we expect data centers to continue to be built. We expect power to continue to be scarce. Pricing power for the IPPs will only go up from here as they contract with data centers. But you're going to have one-off communities here and there that get spooked by data centers and put in things like this one-year moratorium. So there'll be a little bit of a back and forth, but overall the trajectory is higher.
And with that moratorium that we're seeing in Texas, and we've heard it from other places too, are more places coming online, or are there enough people that say, you know what, we'll take this, we'll take the jobs, we'll take the money that comes with it?
I think as the education process continues, they understanding the tax benefits, the job benefits, the economic benefits of having data centers and data center construction in their areas. And so you have places like Ohio, Pennsylvania, most parts of Texas, quite frankly, that are very active and are very interested in having more and more data center presence in their markets.
And what are some of the big concerns for people that are saying no to it?
Yeah, I think there's some misperceptions or misinformation out there that the data centers can cause some environmental concerns because a lot of data centers are going to be powered by natural gas. So there's emissions from natural gas. But look, 45% or so of power in the U.S. is already natural gas. So we're already living through that. And it's not particularly, it's not unhealthy. It's fairly clean relative to things like coal, right? So that's one thing. I think the other is the water consumption. So you have farming states like Nebraska, for example, where the farmers are going to push back on data centers because we use water to cool data centers. And so they don't want to lose access to certain water resources. So it's environmental and water.
This is really, big build-outs have been going on for a while, but these data centers, the size and scope of them is fairly new. How many have been built, and what's the reaction been in communities around them?
Well, we've been building data centers for 20 years, so we have some 4,000 or so data centers that are out there. We're in the process of building another kind of 700 gigawatts that have been announced of data centers. So to put that in context, it's not that huge, but it is a big. It's because it's AI now, and it's being talked about a lot in the media, and the power of AI is showing up in our everyday lives. People are more cognizant, but data centers have been built for the last 2 decades.
All right, and with some of the other concerns, the PPI you mentioned pulling it down today. Longer term, is that an issue?
I don't think longer term. I think we're looking at the reaction from the conflict in the Middle East, what that's doing to hydrocarbon prices, and hydrocarbon, of course, flows into everything, almost every consumer product we have out there. And so it is pushing up inflation here. And so I think the index is a short-term blip. I think as we resolve this crisis and we normalize going into 27, that will be fine in terms of oil prices. They'll be structurally higher than they were before. So maybe that's 80 or 90, not 60 or $70 per barrel. But overall, this is kind of more of a short-term kind of hit.
And with Talon itself, does it look well set up for the future for it?
You could not be better set up for these guys. I mean, they are almost entirely PJM, which is where a lot of the activity is happening. They're not even in Texas, which is surprising why Talon being down more than others today doesn't make any sense, quite frankly, at all. But they've doubled their gigawatts in the last 18 months. They're constantly on the hunt for additional contracts, or long-term PPA contracts, which will lock in cash flow, makes them an infrastructure type asset. And as an infrastructure asset, they're going to command a higher multiple than a regular IPP.
And what's the PJM for those who don't know?
PJM
I won't lie, myself included on this.
It is the electricity market that so there's 5 big markets in the U.S. It's it's the biggest. It includes the Mid-Atlantic all the way over to Ohio.
All right, and that's where they're mostly centered.
They're 99% PJM.
Okay, and is that the stablest market for it, or the stablest place to be? Do you think?
Well, 13 states, 13 governors all came out in support of AI data centers, but they also came out in support of data centers. And the data center owners or renters or leasers paying for that extra power, for the extra load, and not pushing that on to the consumer, so the regular ratepayers at their homes. And so there's a lot of support for the job creation and the economic benefits from the bipartisan, these are both Republicans and Democrats, so bipartisan support for data centers and for AI. But you're going to have a little bit of this community backlash here and there.
All right, and who are some of the other key players with Talon?
Constellation is by far the biggest, Vistra number 2, and then you have companies like NRG, which is big in ERCOT and is mostly natural gas, but Constellation and Vistra both have nuclear, which is very clean.
And just quickly before we go, Talon, you still have them at $594 US?
Sure do, yep. Lots of upside from here.
Sorry, I missed that. I missed the last part of it, sorry.
Lots of upside from here.
All right, we'll wrap it up on that note there, but thank you very much for joining us. We appreciate it. And
thanks so much.
Cheers. And that was James West, Managing Director and Head of Energy and Power Research at Melius Research. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Joining us now for some movers south of the border is Bloomberg Equities reporter Matthew Griffin. Matthew, thanks as always for joining us.
Roger, thanks for having me.
All right, NVIDIA is up, and I just have this visual of Jensen Huang running for Air Force One with his suitcase and a shirt sticking out of the suitcase, trying to catch that plane in Alaska. What's going on with it?
Well, Roger, this may really be true in a metaphorical sense. Jensen Huang, the last-minute addition, of course, to the guest list for President Donald Trump's trip to China. And the reaction in the stock underscores, I think, the attention that investors have on this summit, especially with regard to some single names and sectors. Shares up about 2.5% today. There's also some broad strength in the semiconductor sector. Now, what are investors looking for? The eternal question is whether the United States will allow export of its most advanced AI chips. Those are the Blackwell processors. At the same time, what may be more likely is actually movement on the Chinese side, allowing their companies to purchase these H200 chips, which are slightly less advanced. NVIDIA's got some licenses on the U.S. side, but it doesn't seem like those are actually going into China right now. And I think it's also worth calling out a couple of other names to watch. We could have a deal for about 500 narrow-body Boeing aircraft. That would be a massive order for the plane maker. Also, there could be purchases by China, commitments to purchase U.S. agricultural products. That would be a boon to farmers, give them more cash to buy things like Deere tractors, for example. So a lot of names on traders' lists for the next couple of days.
It does feel like this could be something gigantic or it could be a whole lot of nothing. Doesn't feel like there's a middle ground for this, does it?
You know, I would say that expectations are low. They're towards the nothing end. Though I would say there is a chance for maybe a middle ground on a sector-specific level. When it comes to the broader stock market, people are not necessarily expecting a sea change in trade relations, either for the worse or the better. But these agricultural purchases, that's something U.S. farmers really want. There could even be some kind of deal involving both rare earths and semiconductors that could be a problem for shares. Companies like MP Materials, sort of a U.S. national champion in rare earths. So maybe a bit of middle ground for individual companies here.
All right, we got a couple more we have to get to quickly. Wix down, software company taking another hit.
Yeah, so Wix.com, the web development company, just the latest software company to see a deep slump in its stock after disappointing earnings. Wix reported revenue of about $541 million in the most recent quarter. Analysts looking for about $543 million. So not a huge miss. You had some softness in the core web business, also some headwinds in the Middle East. Most of their employees are based in Israel. They said there were some product delays. But again, not a huge miss in percentage terms, but investors have no patience with software earnings right now in the face of these fears of AI disruption. Shares down as much as 32%. That's their worst day ever.
All right. And quickly, Birkenstock also taking a hit because of the war. It just sounds strange to say that.
Yes, so Birkenstock, the footwear maker, called out a couple of headwinds related to the war. They are seeing the inability to actually ship some product into the Middle East. Also, a weak consumer in Europe as energy prices rise. That came out to a €6 million hit, about $7 million. They had a narrow miss on revenue. Also seems like a situation with little patience. Shares down as much as 15% in their worst day since August 2024. And JP Morgan said investors here were looking for a beat and raise. So maybe some high expectations that the company didn't meet.
All right, we'll wrap it up there. Matthew, thanks as always, though, for joining us.
Roger, thank you. Have a great day.
You too. That was Bloomberg's Matthew Griffin. Bringing a stadium built more than 40 years ago up to FIFA standards hasn't come cheap. Even after earlier upgrades, the price tag has climbed to nearly $180 million out in BC. CTV's Andrew Johnson has more.
Bringing a stadium built in the early 1980s up to FIFA standards, even after it was renovated for the 2010 games, has cost close to $180 million. And it's almost ready.
In just 2 days, we will hand the building over to FIFA to finish the final preparations to become a World Cup stadium.
Upgrades include a new video screen, modernized locker rooms, and hospitality spaces. The most talked about upgrade of all will be under the players' feet. It took a team of researchers and professors to formulate the most consistent grass playing field across all 16 World Cup venues. Here at BC Place, they've planted a mix of Kentucky bluegrass and perennial ryegrass, specially grown to survive under a dome. A pitch entirely made in BC, pointed out the Premier.
This grass comes straight out of the Fraser Valley from Abbotsford. Installed by a company out of Langley.
It's now growing in a roughly 35-centimeter deep surface where the roots are taking hold. It'll be kept alive during the tournament with these grow lights. But the grass isn't the only thing growing. The updated FIFA price tag for taxpayers remains a mystery only 1 month out from the tournament.
Our intention was to release that with our partners closer to the date of the first game. But I have asked our team to bring that forward to ensure that we have the total out to the public by the end of the month.
EB insists it will all be worth it, anticipating the World Cup will bring 1 million visitors to Vancouver over the next 5 years and $1 billion economic benefit. The first game of 7 inside this spruced-up stadium kicks off June 13th. Andrew Johnson, CTV News, Vancouver.
And before we go, let's take a quick look at the markets and see where they stand this afternoon. Bit of a recovery, actually, decent recovery for the Nasdaq. It's up by 1.2, and you can see the S&P 500 also bouncing back after an off day yesterday. It's up by 0.6. South or north of the border, we're going north now. We reversed it. TSX, it is off, and it's dropped more since this morning. It's down by 0.8, and still above 34,000. So we'll leave it on that note there. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thanks very much for joining us. Have yourself a great afternoon.